In this video, we're going to take a look at how to perform a basic consolidation from the perspective of financial reporting when preparing the group accounts. Now, this is a topic that a lot of students fear. It can be quite daunting to start with, but as you'll see as we go through this example, if you break it down and take it step by step, it's actually quite a straightforward process. So let's take a look at how we do that.
Okay, and the first part of that, of course, is going back and making sure that control has been established, and that will inform the rules of consolidation. So let's recap what we've looked at so far. So control is established when more than 50% of the shareholding in the subsidiary is owned, and that will lead to a group entity being formed. The parent will produce consolidated accounts, and that will be in addition to its own individual statements. The group statements show all the assets and all the liabilities of the parent and subsidiary as if they were a single group entity. So that's a recap. Let's take a look at the consolidation method. So the idea here is in three general areas when we're looking at consolidation. And the first thing is that we're adding together the assets and the liabilities of the parent and the subsidiary, and that's going to give us the group. Now, it's not going to be as simple as literally adding together assets and liabilities. And for one reason, it's because in the parent's single individual financial statements, we've got an investment in subsidiary line now that we introduced in the previous stage. So when the parent produces its own statements, it has to show its investment in the subsidiary. But because we're adding together assets and liabilities of the parent and subsidiary, we can't add that investment to the group accounts because we're already adding the assets and liabilities. And if we did that, we'd be double counting. So we need to make an adjustment for the investment in the subsidiary when we are doing the consolidation. And similarly, for a similar reason, we have to make an adjustment for equity because we've already included the assets. We're adding together all the assets and liabilities of the parent and the subsidiary. The assets and liabilities of the subsidiary are being added to the group. Equity is just the difference between assets and liabilities. And so if we add equity in addition to the assets and liabilities, again, we're double counting. So we need to make an adjustment for equity. With equity, the share capital that appears in the group statements is always that of the parent only, and the same goes for the reserves. So for the capital part of the statement of financial position, when you are doing a consolidation, you only ever include the share capital of the parent and the reserves of the parent. And that is the basis for the adjustment that we'll make, and we'll show that in an example. But first, to just summarize the way we sort of turn these three key elements into a sort of process or method, and this is called the acquisition method, and it involves replacing the parent's investment with the net assets of the subsidiary. The first step will be to eliminate the cost of the investment. So what we just put in to the parent's individual financial statement, the investment in subsidiary, we need to make sure we are eliminating that from the group accounts. And then we're going to aggregate the statements of financial position together, bearing in mind that we'll have to make adjustments for equity. Okay, so let's go through an example. That's going to be the best way to understand some of these concepts. So again, we have the statement of financial position for P Limited and S Limited. P Limited purchases 100% of the shares of S Limited at par for £100,000 in cash, so similar to the previous scenario. We're going to go through this process, the acquisition method, to show how you would consolidate these two statements into a group statement. Step 1. We need to just get rid of the investment. So that was step 1. Eliminate the investment in S Limited, as I've already explained. If we're including that and the assets and liabilities of S Limited, then we're counting the investment and the actual value of S Limited twice. That's double counting, and so we need to remove the investment. But we don't just remove the investment in S Limited, because by doing that, we are impacting overall assets and reducing assets by £100,000. That means we need to make an adjustment in the other half of the statement to make it balance. And as I've already said, if you include the assets and liabilities of the subsidiary, you don't need to then include equity, the share capital and retained earnings, because you've already included assets and liabilities. Equity is just the difference between assets and liabilities. And so again, you're double counting if you put equity into the group account, the subsidiary's equity into the group accounts. So in addition to removing the investment in S as that appears in the parent statement, we need to remove the subsidiary's equity part of their statement of financial position. So we're going to cancel out their share capital, remove their retained earnings, and that means we've removed any chance of double counting from the group statements, and we've made adjustments to both sides of the statement. So we've reduced assets by 100,000, and accordingly we've reduced equity by 100,000, so we know that the statement should still balance. Step 2 then is going to be aggregation. So all we need to do is add together each line for the parent and the subsidiary. So in the first case, property, plant and equipment, it's 320,000 plus 80,000. In the next line, we don't need to do anything because we have removed that from the group statement and that won't appear in the group accounts. So we move down to current assets and we add up for 100,000 for P, 50,000 for S, etc., etc. And we keep going down until we get to the bottom and we've done all that. And we're going to end up then with the P group, the single group entity. That's what we've been trying to produce. We're producing a statement as if P and S are a single entity. What we end up with is what you see on screen. And you can see that it's balanced. We've removed the investment. We've not included the share capital and retained earnings of the subsidiary. And so we just look at if B and S are a single group, and that is the statement we would get.
So if you found that video helpful, remember to like and subscribe on YouTube to make sure you're getting all the latest Astranti updates. And you can also find us on other social media platforms. We are on Twitter and on Instagram, and you can find us on Facebook in a number of different places. We have groups for operational strategic management case studies. So have a look on Facebook and see if you can find the right group for you.